Ever wonder about US debt and why other countries seem to own a piece of it? It's like a giant IOU from Uncle Sam. Countries buy US debt by purchasing US Treasury securities, essentially lending money to the US government. But why would they do that? Well, let's break it down. Imagine you have some extra cash. You could stuff it under your mattress, but that's not very smart, right? You could invest it in something risky, hoping for a big payoff. Or you could find a safe and reliable investment that offers a small but steady return. That's kind of what countries do when they buy US debt. They're looking for a safe place to park their money, especially their foreign reserves. Those rainy day funds countries keep in different currencies. US Treasury securities are seen as one of the safest investments in the world. This is because the US has a long history of paying back its debts. It also has a stable political system and a strong economy. So, when countries buy US debt, they're betting on the United States. They're trusting that the US will continue to be a reliable borrower. But wait, there's more. Countries don't just buy US debt for safety reasons. It's also part of a bigger economic strategy. See, when a country buys a lot of another country's currency, it can actually drive down the value of its own currency. This can make their exports cheaper and more competitive on the global market. It's a bit of a balancing act, though. Countries have to be careful not to buy too much US debt. If they do, it could actually hurt their own economies. But in moderation, buying US debt can be a win-win situation for both the buyer and the seller. The US benefits because it gets access to cheap credit, which it can use to fund its government programs and stimulate its economy. And the countries that buy US debt benefit because they get a safe and stable investment for their foreign reserves. Now, how do we even know which countries are buying up all this US debt? Well, that's where the Treasury International Capital, TIC, report comes in. It's like a giant ledger that tracks the buying and selling of US securities by foreign investors. This report gives us a glimpse into the global appetite for US debt and helps us understand which countries are the biggest players. The TC report tells us who's holding what, from Japan and China to the United Kingdom and Brazil. It's a fascinating window into the interconnectedness of the global economy, and sometimes it reveals some surprising trends. For example, in late 2024 and early 2025, the TIC report showed a significant sell-off of US debt by foreign countries. This was a big deal because it signaled a potential shift in global sentiment towards the US economy. The great sell-off US debt takes a hit. So what caused this mass exodus from US debt? Well, a few factors were at play. First, interest rates were rising globally, making US Treasury bonds relatively less attractive compared to other investments. It's like when a new, cooler coffee shop opens across the street offering better deals, you're more likely to switch, right? Second, there was a lot of political uncertainty in the US. The return of Donald Trump to the White House in the 2024 election made some investors nervous. Remember, Trump had a history of unpredictable economic policies like imposing tariffs on Chinese goods. This uncertainty made some countries think twice about holding on to US debt, and then there were the tariffs. Trump, true to his word, announced a new round of tariffs on various goods, set to take effect in April 2025. These tariffs, aimed at boosting American manufacturing, had the potential to disrupt global trade and hurt the US economy. This made US debt even less appealing. The big question is, what does this all mean for the future of the US economy? Well, it's a bit of a mixed bag. On the one hand, the fact that other countries are less interested in buying US debt could lead to higher interest rates in the US. This could make it more expensive for the government to borrow money and could slow down economic growth. On the other hand, it's not all doom and gloom. The US economy is still the largest in the world, and there are still plenty of investors, both domestic and foreign, who see US debt as a safe and reliable investment. Plus, a weaker dollar could actually make US exports more competitive, potentially boosting the economy. The key takeaway here is that a balanced approach is crucial. The US needs to reassure its creditors that it's still a safe bet while also addressing the concerns that are leading to the sell-off. This means enacting responsible fiscal policies, promoting global trade, and maintaining a stable political environment. It's a delicate balancing act, but one that's essential for the continued strength of the US economy.